this assumption that the Fed is going to bring interest rates back to 2.5 or 3% in this cycle is baked in all of these different models. Like, I'm sure you every once in a while bump into a few interviews on Bloomberg, and you listen to the bond people, and basically every single bond person says, well, the long-term rate is 2.5, or the Fed will bring interest rates down to 3. Like, imagine those folks, and that's causing them to buy. To be clear, that's causing them to buy yield at 4.25. At 4.25, if your long-term rate is 2.5, it actually looks like a pretty good deal over a cycle time frame. When those folks start to say, I'm not so sure, right? Maybe I need to pencil in a higher number, and we're actually seeing that in terms of surveys of professional economists and dealers. We're starting to see that long-term rate expectation creep up. When that shifts, that totally changes the valuation picture on bonds. And so, bonds, particularly risk-free bonds, treasury bonds, serve as the backbone of the whole economy. If we already saw last summer, it doesn't take that big a rise to start to upend the apple cart and create some risk to stocks due to the rising discount rate if those yields rise. So that's a lot of the rest of the financial system is really dependent upon this continued expectation that interest rates are going to be low for a long time.
Yeah. So the argument when you hear that is that even if the Fed will go back to that rate, even if they have to inflict pain to get there. But you're suggesting maybe they don't go back to that.
Right. Well, I think that's part of the question is if the economy is structurally running hotter with higher productivity, higher demand for capital, lower savings rates, et cetera, you can have an economy that continues and higher inflation. You can have an economy that continues to be fine, right? You can have your unemployment rate at let's say 5, which to be clear, the average unemployment rate is 5, not 3, not 3.5, not 4. It's 5. The idea that you could have an unemployment rate, just in terms of thinking through things, let's say we had long end yields move to 5, and we had an unemployment rate of 5. That seems like a perfectly plausible solution to the macro economy. And that could, and that would be undesirable tactically for the Fed, but in a strategic sense, a 5% unemployment rate would be fine, would be a fine
this is why
outcome.
I asked, is it in itself a bad thing? It sounds like it's just settling where the economy can handle it, right? And as opposed to everyone hating zero interest rates and some of the repercussions that come from that and being worried about deflation, you're in a different regime. The problem and the rub is that the system is built on expectations of it being at 2 or 2.5%.
Right. Those expectations, I always like to joke the fact that the bonds are in the stocks, right? But the bonds are also in the credit, and the bonds are in the loans, and the bonds are in everything. The bonds are in the houses. That's kind of the challenge from an asset holder's perspective is the fact that we're moving to a structurally higher rate may not be so bad for the real economy, but it isn't great for asset holders.